Understanding qualifying ratios, a key component in loan approval. Qualifying ratios are essential tools employed by banks and financial institutions during the loan underwriting process. These ratios, expressed as percentages, are crucial in assessing a borrower's financial health and suitability for loan approval. By comparing a borrower's debt obligations to their income, lenders can make informed decisions about extending credit. In this article, we delve into the mechanics of qualifying ratios, their significance in different types of loans, and how borrowers can improve their chances of approval. What are qualifying ratios? Qualifying ratios are specific metrics used primarily by lenders to evaluate an applicant's ability to repay a loan. There are two main types of qualifying ratios that lenders commonly consider. 1. Debt-to-income ratio, DTI. This ratio measures the total monthly debt payments, including mortgage, credit card, car loans, etc., against a borrower's gross monthly income. It is a critical indicator of financial health and is calculated using the formula \text DTI equals \left, \text total monthly debt payments, \text gross monthly income, \right, times 100. Generally, a DTI of 36% or less is desirable, although some lenders may accept higher ratios, especially in alternative financing scenarios. 2. Housing expense ratio, also known as the front-end ratio. This metric specifically focuses on housing-related expenses compared to gross income. Housing expenses may include mortgage payments, property taxes, homeowners insurance, and mortgage insurance. The formula is similar. \text equals \left, \text total housing expenses, \text gross monthly income, \right, times 100. Standard expectations for this ratio hover around 28% or less. The role of qualifying ratios in loan underwriting. Personal loans and credit cards. For personal loans and credit cards, lenders predominantly consider the debt-to-income ratio. Financial institutions evaluate the proportion of income that goes toward servicing debt obligations. A lower DTI indicates a lower risk for the lender. While lender-specific criteria may vary, achieving a DTI of 36% or less typically enhances an applicant's chances of securing favorable loan terms. Credit scores also play a vital role in determining loan eligibility. A high credit score may offset a higher DTI by indicating the borrower's reliability and commitment to repaying borrowed funds. Mortgage loans. Mortgage underwriting, on the other hand, considers both the debt-to-income ratio and the housing expense ratio. Both ratios must align closely with the lender's standards, influencing not only loan approval but also the amount one can borrow. 1. Housing expense ratio. This ratio plays a critical role in assessing how much of the borrower's income is allocated to housing costs. Because mortgage payments can significantly impact overall financial health, lenders often expect this ratio to remain at or below 28%. However, in markets with high housing costs, such as New York City or San Francisco, higher ratios may be accepted, particularly if the borrower has strong compensating factors. 2. Debt-to-income ratio. Similarly, lenders assess mortgage applicants' DTI to evaluate their ability to manage monthly payments. Conventional mortgages often look for a DTI of around 36%, yet government-backed loans, such as those from the FHA or Fannie Mae, may accept higher ratios, sometimes up to 50%, due to their mission of expanding access to homeownership. Online lending and automated underwriting. In today's digital age, many lenders employ advanced algorithms and software to streamline the loan approval process. Automated underwriting systems utilize data analytics to manage qualifying ratios effectively, allowing for faster approvals and personalized loan offerings. Individual financial circumstances, including credit history and income patterns, further enhance the personalization of loan products. Improving your qualifying ratios. For potential borrowers looking to improve their chances of securing a loan, understanding and optimizing qualifying ratios is essential. Here are some strategies to consider. 1. Reduce debt. Paying down outstanding debts can significantly lower your DTI and improve your overall financial standing. 2. Increase income. Seek opportunities for raises, side jobs, or passive income streams to boost gross income, thereby lowering both HER and DTI ratios. 3. Maintain a healthy credit score. Make timely payments, reduce credit card balances, and avoid new debt inquiries to improve your credit score, which is closely scrutinized alongside qualifying ratios. 4. Understand local market dynamics. In high-cost areas, being aware of local market trends and housing prices can help set realistic expectations for your HER. Conclusion. Qualifying ratios are fundamental tools in the loan application process. They not only guide lenders in making informed decisions but also serve as critical benchmarks for borrowers seeking financing. By understanding and strategically managing these ratios, applicants can increase their chances of loan approval and secure more favorable terms. Whether you're pursuing personal loans or mortgage financing, being acutely aware of your financial ratios and planning accordingly is key to achieving your financial goals.